Bitcoin is money, just like gold is money or housing is money or other assets are money because they have value. It's not really spending money, right? We're not going to buy coffee with it or buy a bar of chocolate with it. It's not really what it's used for, right? Mainly because there are legal tender laws, which means you can't really spend it. Your government may tax you when you dispose of it. So it's not really like currency, but it is a money. Bitcoin is known as monies, the group of assets known as monies. It's non-government. It can be saved or spent, probably not for coffee though. You spend it when you sell it later for the currency of the country that you're in, so you pay your taxes and, you pay the legal tender that people need to accept. Bitcoin is not legal tender, therefore it's not currency. Some countries made it legal tender, good for them, but in most of the world, it's more of an asset. Because it's digital, it can be very versatile. You can save it and spend it, which means you can save $1 billion of it in an investment fund, but you can receive $50 of it for work that you did and spend it on something. So because it's digital, it's very, very versatile. But really what it is a decentralized database for value over time. And so it's an account for the world, right? It's a savings account for the world who want to use it. I want to quickly go back to the macro, which we were looking at earlier. Remember that we have these cycles, the halving cycle every 4 years for Bitcoin, business cycles, election cycles, debt refinancing cycles. So we know that secular trends move up and cycles drive prices over time. We also know that the supply of Bitcoin over time is increasing, but it will eventually get to 21 million coins and then stop. Very different to other types of currency. This is the supply of gold versus BTC. So what we have here is the inflation rate of gold. Gold is seen as a scarce asset, desirable asset, but price hasn't gone anywhere for 15 years or so. The supply of gold is infinite. It's not a scarce commodity. It's a commodity and not a scarcity. Gold exists on the planet and you just find 2% more of it each year. Gold exists on other planets. Elon's going to Mars. How much gold is he going to bring back? Is the price going to go down because the supply just shoots up? Bitcoin is protected by its network and you cannot control it. As it gets stronger, you simply need more and more and more energy in order to attack the network. Well, it hasn't been taken over in 15 years and the network hash rate is going up and up and up. There is more and more and more energy protecting Bitcoin's network over time. Bitcoin's supply is going to reach 21 million and no more can be created ever. You've got the supply of gold going up forever. You've got the supply of everything going up forever. Commodities, there's an unlimited amount of them. Bitcoin is truly scarce. After the halving in 2024, the inflation rate of Bitcoin will drop from around 1.8, 1.9% down to 0.9%. So each year, the inflation rate is 0.9% more Bitcoin in circulation. 4 years after that, it will get halved down to 0.45%. And then halved again and halved again until eventually there are no more coins. This asset potentially is desirable to invest in because it is genuinely scarce. And everything else that we've tried, currency-wise, has not been scarce. So maybe there are some desirable properties here. How about if we compare it to real estate? In terms of an investment, a savings method over time. Real estate has a lot of downsides. You have management costs, insurance costs, stamp duty, or whatever the tax is called in your region, fees. The thing gets worse over time. It degrades. You have to pay a lot of money to upgrade it. It's a very, very high ticket to invest in. If you want to invest in property, buy your own property, for sure, you need to live somewhere. But if you've got money left over, is another investment property the best thing for you? Do you have that much money to pay for the deposit and the mortgage each month? Do you want to save up for another house, which is very, very high ticket? It's massively illiquid as a market. Can't sell 1/8 of a house. Can do that with Bitcoin. It's extremely high cost and high fee when trading in and out, right? Depending where you are in the world, 3, 4, 5, 6, 7%, and then stamp duty as well, if you've got profits there. It's not fixed in supply because you can just create more of it, right? Buildings get higher over time, things get refreshed. The benefit of real estate is that you can use leverage. So yes, you can buy an entire house if you put $20,000 down, if you've got that. So you can use leverage, which means potentially higher gains if you're comfortable with using that leverage. Because a mortgage is leverage. You're taking debt to buy an asset. Inflation adjusted income, because the rental income you can adjust for inflation. With Bitcoin, zero management cost. Hold your Bitcoin in a wallet, doesn't cost anything. Zero insurance cost, although you can pay to insure it if you want. Capital gains tax, you can get around through putting the Bitcoin in trusts or tax efficient wrappers. If you buy in the ETFs, which will increase the management cost a little bit. Upgraded for free by the world, because it's a digital product. It's liquid, it's fungible, you can trade $10 of it on a Sunday night. Right, it's very, very low cost to trade. You're talking about 0.1% as a trading fee. It's digital, it's quick, it's fast, it's easier. It can pay an income. Bitcoin doesn't pay an income because it's money. But you can use money in a certain way. Housing doesn't pay you money either. Your money, your house, if you're living in one now, doesn't pay you anything. It just sits there. It's only when you rent it out do you get an income. Or you can rent Bitcoin out as well. There's many ways to do that. So there are many ways to earn from BTC. There are many strategies to implement. Bitcoin, right, is that type of asset, and it has many desirable qualities. Looking at Bitcoin versus these other types of monies, it just simply has many more desirable assets than those. And so it's desirable for many people. Because Bitcoin is treated by many people as a savings technology, where they buy it with some of their spare assets, save it, you can think of it like an index, a financial index. The reason Bitcoin is a financial index is because it indexes the people that are using it to store and spend value over time. And there are millions of people that do this in different countries, with different income brackets, with different needs, saving at different times, saving different amounts. And so what you're doing, if these people spend and save Bitcoin, some part of their value that they have, you are indexing them, right? You're saying that when you're invested in Bitcoin, the price of Bitcoin is an index for the financial health of everyone that uses it to store and spend value. And because it's fixed in supply, we know that that value is going to be an accurate representation of what people are earning and the value of their output over time. And so it really is unique in that respect. There are other financial indexes in the world as well, where we can index economies. And what an index is it just is a group of things together, and you can trade it easily. So the most popular examples are, this is the SPY, which is the S&P 500, which is the top 500 companies in America. You just buy the asset, you index those companies. Great way to index the economy. You have the NASDAQ, which is an index mostly tilted towards technology companies in America. So you buy the NASDAQ, and what you're doing is indexing technology companies in America. What are you doing when you're buying Bitcoin? You are indexing everyone who owns it and uses it to store and spend. So it's much more diversified as an index than pretty much anything else. It is a world economic index, and it's growing over time as more people adopt it and store and spend value. It will grow with the economic output of its users. During recessions, when people get worried that they will lose their job or that their income will reduce, and they are worried that they have liabilities to pay in the fiat currency that they're paying those liabilities in, they will sell their assets to get fiat currency to fund their liabilities. Therefore, in a recession, you could say the Bitcoin price may go down. More people would want to sell out of it to get fiat currency to pay their liabilities. In bull markets, when the economy is growing, people are earning more, people are feeling more confident, they have more money to store away, because that is a bull market, right? That's when the economy is growing. They have more money to store away, and so they put more into their assets. You have more buyers there, which may force the price up. Cycles, But the secular trend of Bitcoin is clear that more people are using it to store and spend value over time. It will rise and fall with economic cycles. Bitcoin is the index. It is the world index. There is nothing that comes close. This is Bitcoin versus other indexes. This is Bitcoin in orange, the Nasdaq in blue here, the S&P in red, and gold right here in this kind of gold color. So it's very clear that Bitcoin has outperformed everything, as you can see, over time. You can see Bitcoin's price here. These are the other ones right here. Now, it's unfair to compare them because these indexes are indexing things that have been around for, decades in terms of Nasdaq and S&P. And of course, these are broad indexes that index the largest, most mature companies in the economy. And so these are great, absolutely amazing to index those companies to save your money over time, because the companies are producing the value in the economy that we want to get exposure to. We want to index that. Great. Bitcoin does that too. Now, what Bitcoin has is its own growth as well, outside of that index. Of course, the growth is what we're interested in, but over time, as Bitcoin matures, it will be that index, and its growth will slow and its returns will slow over time. But for sure, what we can see is Bitcoin is an index, just like the other things, and even broader than those. Bitcoin is a financial index. Bitcoin is a strong digital asset that cannot be debased or tampered with. Bitcoin is digital property with a low barrier to entry. The Bitcoin network is strong and resilient. Bitcoin benefits from technological upgrades. It's tied to the real world. It is not a platform. It is not a technology company. It is not an enterprise. It doesn't do anything. It is just a digital money, digital capital with a fixed supply, and it's non-government, non-centralized, non-controlled. That is desirable for some people. They may not put 100% of their money in it, but they may use it in some cases. It may be beneficial for them in some way. If you want yield, then you have to take your BTC and do stuff with it. Money doesn't pay a yield. Cash doesn't pay a yield. You have to invest in a bond to get a yield. Same for Bitcoin. If you want to earn a yield on Bitcoin, you have to lend it to someone or do something else. And you can make a decision whether that's right for you. Bitcoin is property that gets upgraded for free and is not controlled. So it is a desirable asset in many different ways for many different people. Some people may not see any desirable characteristics in that at all. Let's now look at crypto's adoption then, because what we need to know is the crypto being adopted? Is there a secular growth? If there is, we can invest, we can trade, we can take advantage of cycles. So very quickly, we can see crypto adoption over time. So this is the Bitcoin chart, and we've seen this already, but what you can see is essentially crypto is being adopted. Price cycles, like I said, but adoption of the network. This is Bitcoin's network growth. So down here you can see these are addresses with a non-zero balance. If there are more addresses, that means there are more people and more activity. It's not one address for one person because you can have multiple addresses, but what we can see is activity and people coming over time does, over time, relate to the price of BTC. So these are, if you look at the orange lines here, addresses with non-zero balance, right? Price moves in cycles around the actual adoption of the technology. This is not an investment in a company or something or an enterprise that produces value. This is not what we're trading with crypto. Crypto is different. It's not a stock. It's not investing in Google or YouTube or anything. It is an investment in a network, like a telecommunications network, like the internet. But this time you can actually invest because it's a monetary network. And money simply is a network. So price cycles, but the adoption is very clear. If we relate the adoption that we've seen so far to the future, you're looking at way more growth in the Bitcoin price with cycles in between. This is growth models of the internet and the mobile phone. They're put in line with what Bitcoin has done over its price, over its history. Price moves in cycles, but Bitcoin's real adoption in relation to its address count has followed a similar pattern to the internet and to the mobile phone. Because it is a monetary network. It's a network that's proliferating over the globe. And so we should expect that to continue at some pace. We don't know if it's going to go along with a mobile phone or if it's going to tail off. But the growth is pretty clear. We're investing in networks. We're not investing in a company, anything like that. This is a network that we're investing in. So what we can see here is growth as well over time. Now, what I do with the Crypto Investor course is update it for free. So check the link below if you want all the free updates. Existing users get it for free. So if you're in the course, you get all of this. This shows all of the data in real time and my latest research on, are these things actually growing? So you can see Ethereum here. We're looking at Ethereum's growth, users, accounts, right? Everything like that. So keep real-time updates of what's going on here, and that's important for investors, right? So that's part of the crypto course, and if that's interesting to you, you can just check the link below. But right here we have the adoption curve of crypto. This is crypto, not just Bitcoin. So in white, you have global internet users, which happened before, and they've put crypto adoption over the top. And as you can see, millions of users. We're actually tracking at a very similar rate to the internet. So what you're doing here is really just investing in networks that are growing massively over time and have that secular growth. And so we're nowhere near the end of this. So as long as we know that these networks have this growth, we can just relax, because we know that the yearly average growth is 30% according to this in actual network growth value. So whenever the price draws down, that's a great opportunity. But if we just invest and wait, we're getting really amazing growth way above most other assets. These are adoption curves. Again, we're investing in a technology here. It's not a company or anything like that. It's very, very different. So we have to treat it differently. And we can choose the amount that we want to invest in our portfolio. You can see many different technologies here. Televisions, VCRs, internet, broadband, radios. They have a big adoption, and then of course once they reach worldwide adoption, of course you can't grow anymore because there aren't any more people. Well, Bitcoin and ETH have had fantastic adoption in terms of their addresses per capita, per person in the world. And of course they're going to start slowing as every network does. Facebook had huge growth and then tailed off, but still had very, very good growth. So we're not in the early days anymore. No way. But we're certainly in that kind of early mid phase where there's still so much growth ahead, and we can just very easily take advantage of price cycles if they happen. But we're investing in technologies here and not companies. So we're not looking at P&Ls or profits or anything. No, this is an adoption story. This is what we're investing in. It's Metcalfe's law. And Metcalfe's law states that the financial value or influence of a network is proportional to the square of the number of connected users. So two telephones can make one connection. 5 can make 10 connections, and 12 can make 66 connections. As more people join the network, it becomes exponentially more valuable because they join the network, you can communicate with them. That is what we're investing in. We're investing in networks over time. And the networks, if they're growing, we can be super confident to invest in these. As an example, this is the Ethereum network, which is growing. So this is something I discussed in the course as well. But what we can see here is, you can see this red going up here. So this is activity on the Bitcoin network, on the Ethereum network over time, and the layer 2 networks, which are scaling it up to more users. Cheaper transactions, more users. You can see what's happening, right? There is a proliferation and a growth of this network. So we're investing in networks. These networks are being adopted, just like other technologies, and we're still early on in the adoption phase. Now let's come to altcoins and how they fit into this entire industry, because Bitcoin, of course, is the leader and it's the reason for everything else in this industry. And many people back in the day would, of course, call everything other than Bitcoin a shitcoin. And that makes a lot of sense if you know the kind of culture that was happening around then, which was Bitcoin was invented, and clearly a very important invention. And people wanted to change it, right? Bitcoin is fairly slow, and it has 10-minute block times. And there were many people that said, look, we need this to be quicker. We need to change it. We need to make the blocks bigger in order to get more transactions in so we can, scale up the network. And people tried to change Bitcoin. People tried to copy Bitcoin, take the code and manipulate it. Well, all of those copies have failed, right? So if we look at the CoinMarketCap rankings, Bitcoin is number one. All of the Bitcoin copies that were made, Litecoin is kind of its own thing, but you have, Bitcoin Cash, Bitcoin Satoshi's Vision, and loads of others down there. They have clearly failed against BTC, right? They are losing value over and over and over again against Bitcoin, and they were originally the things called shitcoins. However, in the modern era, you now have these projects here that just, are not trying to be Bitcoin. They're not trying to be a different Bitcoin. They're trying to be their own thing, and they're trying to use cryptography and these platforms to bring useful things to us. And so I think calling these shitcoins is obviously dumb, firstly. And secondly, it just means that you haven't spent any time researching what is the use case of this. Is it useful? Is it a thing to invest in? So that Bitcoin is always going to be the leader for many reasons, but there are other use cases for this technology as well, and so let's go through some of those. So really, in the modern era of crypto, what we're really looking at is smart contract chains, and then on top of that comes all of the other stuff. So Bitcoin was invented to send Bitcoin from one wallet to another, and that's kind of all it does. Now, there are other things you can do with Bitcoin. For example, recently, ordinals and inscriptions have been being used more. And these are ways to put extra pieces of data in the block along with a transaction. And so if you can include data in a transaction, it means that you can include other things other than just sending Bitcoin. For example, text. And if you have text in a block, in a Bitcoin block, it essentially means that you have inscribed something on the Bitcoin blockchain that will be there for the rest of eternity, as long as Bitcoin is, a network that actually survives, right? So it's a little bit like cavemen painting pictures in caves of the things that were around them at the time, right? That was the way that they could have a memory of that. Well, if Bitcoin is a blockchain, basically a decentralized database, then you can put things in that database. Now, that has a specific use case, because you have to pay for this. So maybe things that are really important, for example, history or other articles could be inscribed on this chain. And so that makes the blockchain obviously more valuable, because you have a reliable database that can't be tampered with, and you put things on it that are really important for humanity to keep a record of. So that's the use case that comes out of Bitcoin. But it's not just sending one coin from one wallet to another. And so there comes ideas, right? Humans have ideas, and entrepreneurs make things to, try and make money for themselves, and hopefully through, capitalism, provide things that are valuable to the rest of humanity as well. So what this all comes out of is that Bitcoin is slow and you can't change it. And that's good. But people want more expressivity with the products that they have. Now, Bitcoin is very non-expressive. It's very difficult to really include any data. Moving up the scale a little bit, you have Ethereum, which tries to be more expressive. And so you can write in different things like smart contracts, other types of tokens, right? And then you come maybe to other ecosystems that want to be even more expressive still. There are many minute details here that I just can't get into, otherwise the video would be 15 hours long. But essentially what the industry has become is a base layer down at the bottom. And so that base layer does a couple of things. It hopefully becomes distributed as a computer system so that that blockchain is reliable and trustworthy. And if it's not reliable and trustworthy, it's literally worthless, right? Because you just can't keep anything on there. Right? That's why we don't keep money, on these centralized players like Google and Amazon. It'd be very easy for them to come up with like an e-money system, right? We have these e-money systems like Cash App or whatever. Like, it's not difficult. But the invention of crypto is not centralization, right? If you have an e-money like Cash App, they're centralized. They have their dollars in the bank and you can send them around. That's not the invention of crypto. The invention of crypto is to have a decentralized system. So the base layer down at the bottom is really just decentralized network that allows you to code certain things into it. And so they all have slight differences, but really that is smart contracts that enable people to enter into an agreement with that protocol, and no one else can change that when they enter into that. Tokens that come on top that can make better use cases, right? So you can issue stable coins, you can issue exchange coins and DeFi coins and everything else. But at the base layer, you have that system. Now, there aren't many of these. And the reason is, once you have a couple of genuinely decentralized neutral networks, you don't need any more, right? Because you have one already. And so there's a few of these, and they seem to be large. If you look at crypto market cap, these really now take up the bulk of the industry. So all I want to say here is that Bitcoin and Ethereum, these two coins, despite there being, you can just see this here, despite there being 12,000 coins in existence, Bitcoin and Ethereum take up 80% of the value of this industry. So that really tells you how mature crypto is. It's not very mature, but also that once you have a genuinely decentralized and neutral network, you kind of don't need to use anything else, right? Once that's invented, then as a business person, as an entrepreneur, as an inventor, whatever, you can't invent that again. And so you have a couple of these that just simply are going to be very big. And then the industry matures by building out stuff on top. So the base layer down here, and these are kind of the main ones that have most of the value in the industry. So as we come down, you have BNB, Solana, XRP. It's a little bit different, but similar thing. Cardano, Avalanche, Polkadot, Tron, Polygon. And that's kind of it. I mean, there's a few different ones here that have launched recently, like Near and Aptos, which really are trying to do something different again, much more specific. So when you have these large kind of generalized decentralized networks, there aren't that many of them. Now, on top of that, you have scaling and other types of infrastructure. And so the difference here is that this base layer, this asset, is a different asset than these, right? And so it's going to earn money in a different way. It's going to have a different value, and it's going to have a different type of longevity, we hope, right? Because if you have a large decentralized network, very large, very big, that's different than these, which are more specific. So these networks, they really need to be secure first, which usually means slow and expensive as well. But of course, that's not a great use case. It only has a specific use case for money and a store of value, which Bitcoin is. So on top of that, we try and scale out those layers to make the use case scale to more users, because you can't just use a Bitcoin blockchain. It's too expensive, right? And so we try and scale that out in different ways, or through Ethereum or through the other chains. So I haven't put Bitcoin here because I just think it's kind of different to these. But Bitcoin, if you had the Bitcoin base layer here, the layer 2 on Bitcoin would be the Lightning Network. So the Lightning Network is trying to be a scaling payments layer, and it's difficult work, but it's got some trade-offs, but you're trying to scale that payments layer. So for these smart contract chains, that happens as well, because you can't just put everything on the base layer, because there would be too much data to store. And if you have a lot of data to store, it means that only rich people or corporations can do that, and then that obviously centralizes things again. So you have to keep that base layer small and lightweight, and then on top, you try and scale it out. So as you can see here, for example, Ethereum, that scales out through many different networks on top. So you have these layer 2s. What these do is they sit on top of Ethereum, and they batch up transactions. And so let's say they have 1,000 transactions on that network. Instead of 1,000 transactions going to Ethereum, you have 1,000 transactions on the layer 2 network, and they batch them all up together and send them down as one transaction onto Ethereum. And so they're paying the Ethereum fee, which is slightly more expensive, but they're spreading it out over 1,000 transactions, or however many it would be. And so that's a way to try and scale. And so you get these scaling and infrastructure layers, right? So there's many things that you need for a smart contracts chain, because you have contracts. which means you have price feeds, which means you have other data feeds, which means you need lots of things working together to make sure that everything is accurate for contracts to be agreed and obviously gone through with. So you have scaling layers like this, which can scale out blockchains. You have oracles. Now, oracles take data from other parts of the world. So from TradFi or from other blockchains, they take that data and they feed it out to the blockchains and all of the applications so that they can have these price feeds. How would this make money? Essentially, you're charging a fee for that data, right? So if you're a blockchain or if you're an application and you want price data, you have to pay a service provider for that data, and so that's where the money comes in. So I'm switching into how to make money now because this is really just enterprise, entrepreneurial businesses, right? That's what they have to be. So really, they're not money, right? They're not decentralized assets. They're much more centralized at this layer. And so they're really just kind of businesses that need to make money, right? So these guys make money by, taking a kind of percentage profit of what they charge their customers and what it costs them to settle down to the base layer. Something like Chainlink and Oracle will just charge people fees for its data. Polygon is layer 2s, other types of chain development kit, bits of infrastructure that other networks or applications can use, and they pay a fee for that. Right? You have companies like Binance, which develop infrastructure in a lot of different places. But again, everything has to be a fee or a payment, right? And there has to be money to be made and profits to be made. You have Coinbase as well here, which are building out layer 2 networks on Ethereum. So how do they make money? Again, they're a layer 2, so they're making some money out of that difference between what they charge and what they pay. But also, they're going to be making applications on their chain. And of course, Coinbase, as a public company, is going to be investing in venture. So, dApps, DeFi, other applications that make money, they want to be investing in those, taking fees from customers, and they need a blockchain to do that, and of course, they want their own chain. You then have things like Anchor, which provide RPCs, which is how blockchains communicate with wallets and everything like that. You have decentralized storage solutions as well, like Arweave and Filecoin, and also BNB Greenfield, which do things. Again, these are businesses that have to kind of charge a fee, right? And then you have cross-chain bridges like Stargate, which charge a fee for you to send crypto from one chain to another. So I don't want to say these are good or bad or anything like that, but I just want to differentiate between a base layer asset and then everything else, which is just a business that needs to make money. And then on top of that, you just have this massive proliferation of applications. So how can people take advantage of the ability to send value across the world, peer-to-peer, without any intermediary, right? And so what is the use case for that? So that spawns DeFi, decentralized finance. So you can trade, you can lend and borrow, and you can create derivatives. So, in the financial world, derivatives are absolutely massive. So these are futures and options. So if you are someone that has, produces wheat, you want to sell that. So you want to sell your crop now that you haven't harvested, right? You're selling in the future. So you want to lock in money for your crop now. You can do that if you want through futures or options. And so all of this can be done on these networks as well. Staking as well, which is proof of stake blockchains will pay staking rewards because they earn fees and then they pay the fees out to investors. And so you have infrastructure players here like Lido, Stader, Binance and Coinbase do this as well. Right, so what are they doing? They are providing the staking infrastructure. They receive the fees from the blockchains and they pass it back to the investor and they take a small fee. So everything here is business. NFTs, of course, we know how that's something that, you can put on blockchains. NFTs and ordinals are similar. But of course, a non-fungible token is one of the inventions of blockchain. And so you can have exchanges, other types of protocols that either let you create them yourself or trade them or whatever. Then, of course, gaming, because these networks now can use money. Right now we have stable coins and other types of money that we can use within games. you can either win actual money in games, or maybe there can be social networks with that as well. So there's lots of different ideas here that spawns from having money on chain, value on chain, right? This is all value on chain, right? Because this is what Web3 is Web2 is a few companies that run databases that will read and write, and then they keep all the data. But now this is the proliferation of no one owns your data, it's all on the blockchain, and so we can move value around. And so all of this is just moving different things of value around, right? And so you have DePIN, which is decentralized physical infrastructure network. So what they're trying to do, this is Render, Helium, World Mobile. Binance runs a lot of infrastructure here as well. So what they try and do is meet buyers and sellers of something in the middle, right? So you have these guys which try and run small-scale networks and telecommunications networks. And so if someone has Wi-Fi that they want to sell, or 4 or 5G that they want to sell, if they have a mast, they can sell that to people that buy the network, buy that connectivity. And of course, you have money that can very easily transfer between them, right? Ordinals are the same thing as NFTs, more or less, like I explained. Then you have stablecoins, which are probably the number one use case of crypto. They're definitely the most successful use case right now, the largest use case. And these are simply fiat currencies on the internet. We've never had that before today, which is crazy to say, right? When you buy something online, you're paying with a card. It takes a week or more to actually settle with the banks. It's a complete nightmare. Well, now we have pretty much instant settlement of money online through stablecoins. And people don't really want to use these to pay for things. These base layer assets have become assets because what they do is they charge a fee for security and hopefully make profits and then pass that back to investors. So I would say these are crypto assets. They're not money, in my opinion. They're not money, they're not currency. No, they earn fees, pass them back, and so they're an investment, right? And so people don't really want to trade those around and spend them for stuff. That's not really how people behave. And secondly, these are going to be taxed if you get rid of them. If you sell them, they're probably going to be taxed in your country, which makes it just unfeasible to use them as something to spend. And so these are investments, but these are currency on the internet. And so obviously they're going to be one of the biggest use cases, right? Because you can now send money around. Now, if you look at Tether and Circle, these are probably the most profitable businesses within this entire industry. Because what they do is they take dollars from their customers, who are mostly institutions. So an institution will give them $1 million. They will issue 1 million units of Tether, 1 for 1, of course, because it's $1 in a bank for 1 USDT. Now, that stablecoin is online, and it's circulating on any of the chains that they operate on, which is most of these. Now, what Tether actually do is they take that dollar and they invest it in short-term government debt, mostly US debt. I think it's all US debt now. Money market funds, very, very short-dated, like 1 month, 3 month bills. Now, those earn yield for Tether, right? So they have an amount that they're making on whatever the circulation is. So if you look at Tether, the circulation of Tether is 95 billion. Call it $100 billion. So Tether as a company have $100 billion worth of client money, and they're investing that in short-dated government debt, which let's say that pays around 3%. Well, they're giving 0% back to their customers because this thing doesn't pay yield. So essentially what Tether are doing is earning 3% on $100 billion and not giving any of it back to their customers. Now, that's really good business. And this is what USDC do as well. Now, what's happening because competition is that now you have stablecoins that say, wait, hold on. What we'll do is actually pass that yield back to you. So this is where USDM comes in. It's one of the new ones. Again, I don't want to promote any of these coins at all. There are many, many risks in owning crypto, especially coins that are issued by centralized issuers. These aren't decentralized at all in any way, right? None of this is decentralized. These are companies, right? These are created by and run by people. But I just want to show you the outlook of the industry. So something like USDM, essentially what they do is you give them $1, they will invest that dollar in short-dated US treasuries, and they'll actually pass the yield they get back to you. Now they're going to take 50 basis points or 20 basis points, whatever it is of the yield, as their fee, which is fine because that's what money market funds do anyway, right? They'll invest anything and they'll take a small fee out, obviously, because they're running a business. So now you have competition. So now what we have, potentially, is the ability to hold fiat currency online whilst always receiving the risk-free rate. Now, the risk-free rate is something that we call the base rate that you can get if you invested that fiat currency in the government debt. So US Treasuries, if you have $1, right, cash, that's not earning any yield. If you have $1 invested in Treasuries, you might be earning 3%. That's the risk-free rate because the government is never going to default on its debt because it can print money to pay you back. We won't get into how they do that or why that's actually a bad thing. But if you're getting cash with 0 or a US Treasury at 3%, which is basically the same thing, you'd rather the 3%, right? Well, that's what these are enabling. So you can essentially own dollars and receive the risk-free rate in your account, like a checking account, and you can spend them out whenever you want. Now, if you contrast that with a bank, you're going to have to put it into a savings account or a CD or something else where you may have to lock up your funds. So these are one of the most important inventions coming out of these chains that allow for value transfer worldwide. Visa are starting to use blockchains as well and testing it out for payments as well. So stablecoins are important. Now, we can't really invest in these. Tether is a private business. Circle is private, but as of making this video, maybe going through an IPO. So these are going to be stocks listed on the market, so you can't really invest in them, maybe if they're public companies. Then, of course, with value transfer or data transfer around the world, that spawns experiments with social media as well. So you have Nostr here, you have Farcaster. Nostr is Bitcoin-based, Farcaster is Ethereum-based. This is where you can actually keep your data online, on-chain. Right, so let's say you have a decentralized ID, which is a DID, decentralized IDs. You keep your data, you keep all of the stuff that you post, including messages between friends, you keep that yourself, and you can bring that data to any client that you want. Right, so rather than now we have Facebook, is if you use Facebook, all of your data is owned and on Facebook servers, and your history and everything, you can't take it with you anywhere else. With blockchains, the potential is that you can have your data associated with your wallet kept on the Ethereum chain or maybe layer 2s, and you can use any client that you want. So if client ABC, you don't like the design or they change something, you can just take that to client C, and all of your data and history just moves over, and now you have a new interface. These are very, very new and experimental, but obviously something that seems pretty important. And then what is very important is decentralized IDs or DIDs. And we're going to have these more and more, which is our ID, right? So we can put our ID in these, and it has certain things about us that these applications would need to know. For example, what country are you from? Because some assets you can trade in some countries, some assets are blocked, some laws prevent you doing certain things. And of course, right now, we can do all of that on chain without any issues. In the future, it's pretty clear that governments aren't going to like that. And so what they're going to try and enforce is decentralized IDs, where you can actually put your kind of ID info into this DID. Now, the advantage here is that essentially you can prove to applications something that they need to get proved without revealing the actual information about you. So, for example, if I want to trade something on a DeFi app and there are certain restrictions based on your country, well, with your DID, you can prove to the application that you're from a certain country without revealing your name or your address or where you live or your phone number or your ID card with your photo. So you can just say to the app, look, I've got this bid and I'm from a country where I can trade. And they say, okay, no problem, we'll let you in and trade. You don't have to reveal your info. And that can work across many different things as well. So it's an upgrade to the current system. So that is an overview of kind of the base layer and then everything, on top, which is basically a business that tries to make the use case better and bring it out to more people.